Hi, Michael. Okay, good. So tonight we're going to finish up with income taxes. I can remember vividly that I gave you some assignments on income tax. And speaking of IAS 12 on income tax, we already established that they are current tax and deferred tax. We have explained the current tax and the major technicality in current tax is just two things. Number one is the fact that current taxes are determined at the end of each year. So basically, every company would do an estimate, and they are payable in in the next year when they eventually file their returns, which usually results in under or overestimation for tax, particularly when the tax authority comes up with a desk review, which in all of the cases I've seen so far in my years of experience, what they will come up with is always different from what you have actually filed. So we looked at how under provision is accounted for by adding it to the P&L of that year, and also over estimation for tax. That is usually as a deduction from the income tax for that year. Then we went on to deferred tax. You see, why current tax is actually tax payable or recoverable in current period in respect of taxable difference, in respect of taxable profit. Deferred tax is tax payable or recoverable in future period in respect of temporary difference. That means that the major thing we needed to learn in deferred tax was how to determine temporary difference. When we're able to determine that, then apply 30% on that, it gives you your deferred tax. So it now depends on whether that temporary difference will result in a taxable temporary difference, which results in a deferred tax liability, or a deductible temporary difference, which results in a deferred tax assets. And we already established that temporary difference is just the difference between the amount you put in your books and the amount the tax authority is ready to capture or will capture. That's the tax base as it were. So we looked at all of that. We solved a lot of questions. Tonight, I will just do the solution of the questions I asked you to solve. And again, while I was teaching the other class this same topic, I realized that we made some errors in some of these questions. I think I'll correct that first. It's not easily noticeable, but I just remember that, no, this is not how I solved it for you guys here. Yeah, this particular question. So we made an error here in this is our solution that we did here. It's good we made that error, so you will use it to learn. So I needed to correct it first. So this question actually requires that we calculate a deferred tax charge or credit, which will be recorded in Babangida Nigeria Limited statement of profit or loss and other comprehensive income and deferred tax balance. Okay, so the period where they asked us to determine the deferred tax was actually 2021. And we can see that this asset was acquired in 2019, useful life 10 years, residual value 2 million. Depreciation is on a straight line basis. And in lieu of depreciation, the tax authority gives 40% of costs to be claimed against income tax in the year of purchase and 25% on its tax based on reducing balance, and they gave us a tax rate. See, what we did straight was to jump to 2020 and 2021. So, and why did we start from 2020? It shouldn't have started from 2020. It should have started from the first year when the asset was acquired. The asset was acquired in 2019. So why did we start our competition from 2020? So it usually should be started from 2020, 2019, because deferred tax is done, is recalculated, is measured every year. So from the date of acquisition, you need to continue to remeasure your deferred taxes, but we mistakenly started from 2021. So it wasn't like a mistake per se. Is the fact that we didn't start from 2019. We actually started from 2021. So this one, we actually started from 2020. So this one that we wrote 2019, it should actually be this one that we wrote 2020, it should actually be 2019. So that's just the only mistake that we made. So this 2020 should be 2019, and every other thing is right. Then we should perhaps then do 20. This next one that we did here should then be 2020. Okay, every other thing we did is also correct up to this point. Then that means it's still remaining 1 year that we have not done, which is 2021. Which is 2021. Okay. So again, we just need to compute the carrying amount. And compare that with the tax base to get our temporary difference. And the carrying amount still remains our costs, and the cost of these assets is still 10 million from the correction. It's still 10 million. The accumulated depreciation now, if you had revised it, you will have seen that from year 1, we have since gotten an annual depreciation of 800. In year 2, we just cumulated it, 800 times 2. In year 3, it should just be 800 times 3s to get the cumulative depreciation. Then we're looking at 2,400 as the accumulated depreciation. If you do your deduction, you should be looking at 7,600 as the carrying amount. So the tax base, since we're told that the capital allowance or tax depreciation is 25% on its tax base subsequently on reducing balance basis, it's similar to the way we did for the second year, where we did the tax base brought forward, which is this tax base of last year. We brought it forward. Then we apply 25% on it. The same thing we will do here too. We'll do the brought forward. Now, what was the tax base of? It was 4,500. So we are bringing that 4,500 forward. Then the tax depreciation of this year is just simply 25% of that. So if you do 25% of 4,500, what would that give you? Can you please help me with the calculation of that?
1125. 1,125.
1,125. So if I deduct that, what's my tax base? How much?
3,375.
3,375.
Okay, 3,375. So if I compare my tax base with the carrying amount, I have a deduction. So I should be looking at a taxable temporary difference. Taxable temporary difference of how much? What's the difference? What's the difference? 7,006 minus 3,375.
4225.
4225. So we can then do our deferred tax liability at 30%, which is 30% times 4225. What would that give us?
1267.5.
1267.5. Okay. So I have my deferred tax position as at the end of 2021. Okay, this should be 2021. So this is the deferred tax that would show in my statement of financial position. Okay, however, the deferred tax charge or credit that will show in my P&L is simply calculated as the opening deferred tax, compare that with the opening deferred tax, compare that with the closing deferred tax. So the opening deferred tax will be the deferred tax of the previous year, which is that of 2020, and the closing will be the current year. The closing is what we have computed up here, which is 1267.5. The opening is that of 2020, which is this 1170 up there. So 1170. So the difference, what's the difference between the two? This looks like an increase in deferred tax.
I think I was thinking the 2019 will be opening.
Nope, is 2020. So you see, if not that this question was specific about 2021, for 2020, if you want to get the deferred tax that will go to P&L in 2020, that's when 2019 will become the opening. Okay, so that you just compare the opening, which is that of 2019, with that of 2020 becoming closing. Then that difference is what will go to P&L as deferred tax in 2020. But in 2021, you're comparing this 2021 deferred tax as closing and the previous year, which is 2020 deferred tax, as opening in this case. So what's the difference?
97.5.
97.5. Okay, so this was the error we made, now rightfully corrected. So, and I hope you know that if this question had been that we should calculate the deferred tax balance. Yeah, sorry, hold on. Let me just finish the point I'm trying to make. You know that if this question had been that you should calculate the deferred tax balance for 2019 and also the deferred tax charge for 2019, you will have just done just this year alone, which means that it's this 960 that will go to P&L and also will go to statement of financial position. Okay. If the question had been the deferred tax charge for 2020 and also the balance for 2020, so it will have been this balance we calculated here that will go to statement of financial position. Why is the increase or decrease, in this case, increase between 1960 and 1170, that will have gone to P&L. But what the question really requested for was that of 2021. So while this is the balance that will show in the statement of financial position, what goes to P&L is the increase between the current year balance and the previous year balance, which gives us 97.5, and that's what goes to POL. Okay, now you can ask your question, please.
Hello, sir. I just want to get the difference. Okay, here we have deferred tax liability. So this difference, this 97.5 now that will be added to POL, will it be added to income tax or will it be deducted from income tax? Will it be added or deducted?
It's going to be added.
Okay, so when it is deferred tax assets, will it be added or deducted?
So it will have been deducted. It is deferred tax assets.
Thank you, sir.
Because that's going to result in a deferred tax income. And also another one you should know is that if it had been a decrease, this one was an increase in deferred tax liability. If it were to be a decrease, okay, that decrease also will have been deducted from income tax. It will have been deducted from the current tax and P&L. Any other question? Okay, no, that's not the only one. There was a similar one also that we solved. Let me see. I think that's all. Okay. So let's solve the remaining questions that we did not finish that day. So I needed to solve it because a lot of you did not do the assignments. I don't know why. But nevertheless, it's important I guide you. So if you look at this question, so this question says that accounting for deferred tax is based on the identification of temporary difference. You already know that. They now said explain the term temporary difference and discuss the two different types. Okay, so I won't have to repeat this again. You know that already. The difference between carrying amount and tax base, and the two types are deductible and taxable. So you can always check that up. Also, we are asked to state and briefly explain 5 components of tax expense or income. And those components are: 1, the current tax expense or income; 2, the adjustment to current tax expense or income of prior periods. That is the under or over estimation for tax. That is also another component that needs to be disclosed. Also, deferred tax expense or income arising from temporary differences. Also, deferred tax or income arising from unused tax losses or credits. Also, movement in deferred tax between the opening and closing. All of these are components that you disclose in the notes to the account. So, and you have it here in this handout. Where is it? This is it. All I've just mentioned is these are the components here that you have in your handout here. Okay, so we're now asked in the second part of the question. This talks about Buga Nigeria Limited, that he had an accounting profit of 196.8 million for the year ended September 30th, 2022. The following balances were extracted from the company's books as of September 30th, 2022. So we're given these balances, right, from the non-current assets down to the current liabilities. And they give us some other information. Number 1, we're told that interest income is taxed, while interest expenses are liable on a cash basis. We're also told that there were no opening balance on interest receivable and interest payable. We're also told that the trade receivable above is shown net of allowance for doubtful balances of 16.75 million. This is the first year that such an allowance has been recognized. A deduction for debt is only allowed for tax purposes when the debtor is in the process of winding up. Number 3, the balance in respect of office equipment are after charging accounting depreciation of 22 million and tax allowable depreciation of 22.5 million respectively. Finally, we are told that the field property was purchased on October 1st, 2021, which is the beginning of the year, considering that the year end is September 30th, 2022. So purchased it for 263 million and it's been depreciated for accounting purpose on a 10% per annum. Morgan Nigeria Limited is in position to claim 94.6 million as accelerated depreciation on cost as taxable expense in the year's tax computation. We're now required to prepare tax computation and calculate current tax expense. Also, we're required to calculate deferred tax liability at the end of the year. We're also required to show the movement on deferred tax account for the year ended September 30, 2022, given the opening balance of 8.1 million. These three questions will give us 12 marks. Fair enough. Okay, so solving it. The first required that you should prepare a tax computation and you should calculate the current tax expense. Okay, so that means this number one wants you to determine a taxable profit. When you apply 30% on that, that gives you your current tax expense. Good enough, I was given my profit before tax of 196.8 million. Okay, so let's start from that point. So let me firstly do my computation of taxable profits and current tax expense. First, my profit before tax. Let me put my narrow, do it like this. Okay, my PBT, my profit before tax is 196,800. From here, 196,800. So majorly, I would add back disallowable expenses, and I know depreciation will be involved. And what are the depreciation given to me in this question? For the office equipment, the depreciation is 28,250 for the office equipment. Yeah, 28,250. 28,250. And for the second asset, which is a field property, I was told that it's been depreciated on accounting purpose on 10% per annum. So if I do 10% of 263 million, I should be looking at 26,300. Should be looking at 26,300. So can you sum these two for me? Can you please sum
54,550. 54,550.
Thank you very much. Going forward, I can see that from this note one, that interest income is taxed and interest expenses are allowed on a cash basis. Okay. That means that for the interest income, it will be taxed maybe next year or in the future. For the interest expense, that means it will be deductible next year or in the future, but it is on a cash basis when the cash is involved. So the disallowable expense here now is the interest expense because the tax authority will disallow it now because they are saying you haven't paid it. So let's disallow the interest expense. Interest expense. So how much is the interest expense? So I was told that there were no opening balance on interest receivable and interest payable. Okay, So this interest receivable and interest payable, for there not to be opening balance, that means they happen this year. This is their first year. Apparently, that then goes to show that our interest income for this year is actually 3,250. That means this is the other debit of interest receivable. It's like credit interest income, debit interest receivable. The same thing applies to this interest payable. Since it's happening in the first year, that means this interest payable is also the interest expense for this year. So this is my interest expense for this year that I'm going to disallow. 10,850. 10,850. Okay. So I haven't mentioned that. I'm told that the trade receivables above is shown net of allowance for doubtful debt of 16,750. This is the first year of such allowance has been recognized. A deduction for debt is only allowed for tax purposes when the debtor is in the process of winding up. Okay, so that means the taxman will disallow this 16,750. The taxman is going to disallow it. So 16,750 disallowable expense as provision for doubtful debts, 16,750. Okay. Then this is talking about the depreciation, and that's it. And one thing you should not also omit is this fines payable, because fines are usually a disallowable expense, always a disallowable expense. So this 32,500 fine or penalties are disallowable. So 32,500, it should be disallowed as well. And those are all my disallowable expense. So can you please add these 4 items for me and see what it gives us? Waiting.
114,650.
114,650. Now we are going to deduct exempt income or non-taxable income. And what are the non-taxable income that we have? First, I recall we have an interest income that is not taxed now, but will be taxed on cash basis. So, where is it? This 3,250. So I have 3,250. Also, that's only non-taxable income. Then let me deal with my capital allowance. I really have to do my capital allowance. So I want to follow the template. So can you add this and deduct this? What will it give us?
193,664 naira.
Okay, and I can then deduct capital allowance.
664 plus 64.
Okay, thank you. 664. So my capital allowance for the office equipment, the capital allowance is 22,500. That's what they call tax allowable depreciation. So 22,500. And for the freehold property, the capital allowance is 94,600. 94,600. 94,600. So what's the addition? The two.
117,100 naira.
Okay. So what do I have as my taxable profits? My taxable profits.
76,564 naira.
So my current tax expense is simply 30% times 76,564. What do we have?
22,969 naira. 0.2. 3.2.
Okay. I can see hands raised up for questions. So can we start with Kelvin?
The figures is not correct.
Oh, okay.
Exactly. I wanted to say that.
It's not correct, sir. The figure is not correct, sir.
Okay. All right. So Ufoma, is that your question too?
No, sir.
Okay, so
The
what,
tax rate is not given. So how do you assume that 30%?
it has to be given. No, you cannot, don't assume.
Speak to. I need close.
Catch and mute. Charity. Okay. Yeah, it wasn't given. So that's their bad. But the tax rate in Nigeria for large companies is 30%. So we use 30%. Okay. So can you give me the correct figures? I'll leave it to you to go and correct.
No, sir. The accessible profits is 308,200.
150.
308,200.
Okay. So what's the taxable profit?
191,100 naira.
What's the current tax?
7,330. 57,330. 57,330 naira.
Good.
Yes.
Okay. So the second part of the question requires us to determine the deferred tax liability, which is the deferred tax balance. And how do we determine that? Second part of the question, computation of deferred tax balance. So, and to get deferred tax, you need to determine your temporary difference. So, for temporary difference, you pick your assets one by one. It's determined based on the carrying amount and tax base of asset and liability. So the best way for you is most likely pick up these assets one by one and determine their carrying amount and tax base. So usually even these are we even do it in practice as well. So I'll get my carrying amount, I'll get my tax base, I get my temporary difference. Temporary difference. Okay. So first, I start with the first asset, which is the freehold property. For the freehold property, what's the carrying amount for the freehold property? So I was told that for the freehold property, it was purchased in in October, this is the cost. But since you are giving me this, that means this is a carrying amount. What you find on the face of the account is the carrying amount. So carrying amount, the tax base is basically the costs minus the capital allowance. So can you get me 263,000 minus 94,600? Can you get me that? Anybody? 263.
168,400.
Okay, 168,400. 168,400. Okay, so what's the difference?
$68,300.
68,300. So is this a taxable temporary difference or deductible temporary difference?
Taxable.
Okay, this is a taxable temporary difference. So let me just put this taxable in brackets. It doesn't mean anything, just to distinguish it from deductible. So the next asset here is office equipment. Office equipment. What's the carrying amount of the office equipment? From the notes here, these are depreciation. Okay. So the office equipment, this is the carrying amount after deducting depreciation to 5,000. The whatever is on the face of the account is the carrying amount. And this is the tax allowable depreciation for whatever reason they gave me on the face of the account. So, but after deducting that, I get my tax base after deducting capital allowance. So what's the difference between these two?
22,500.
22,500. Is this taxable or deductible?
Taxable.
Taxable.
Taxable. Okay. Ufoma, you have a question?
Yes, sir. So I tried this question, but this line item two, the office equipment. Since the carrying amount is given, I was thinking you had back the depreciation then before you deduct the taxable different allowable expense.
Okay. That makes sense. But it will be difficult to do that in this case because that means you want to be doing it as if you are doing taxable profits. Which asset is this? Office equipment. I would advise that you don't do that because the question is not so clear. So it's just better you use this as your carrying amount and you use this as your tax base. The question is not so explicit because they didn't tell me whether since they didn't give us the cost and all of that. So maybe the depreciation and capital allowance were the same figure at the beginning. I didn't know, so I don't have that details for me to do that kind of working. So when I don't have so much details, I don't do anything complex. So I keep it simple in such cases. So I will use the figure on the face of the account as my carrying amount. Since the examiner has deducted this for me, the capital allowance, I use this as my tax base. So don't start adding it back and deducting. You mostly be wrong in those cases. So that's what I would advise here. But you actually make sense, but the question wasn't that explicit. So the next one, after dealing with this office equipment, is trade receivable. Trade receivable. So this is the carrying amount. So what's the tax base? So I was told that trade receivable above is shown net of allowance for doubtful balance. Is shown net of allowance for doubtful balance. So that means they have already removed this 16,750. So because of that, we would clearly have to add it back, because since the tax authority is going to disallow it, so for the tax base, so just help me add 174,250. Let me add it to 16,750. What would that give us?
191,000.
191,000.
191,000. So what's the difference?
$16,750.
16,750. So is this a deductible temporary difference or taxable temporary difference?
Deductible.
Taxable.
Okay,
Taxable. Or be deductible.
that's deductible. We have more deductions from the interpretation we have given to this other one. So deductible temporary difference. Then the interest receivable of 3,250. I have my interest receivable. So what will be the tax base for this interest receivable, considering that this interest receivable will be taxed? The related interest income is taxed on a cash basis. So what's the interest receivable?
0.
0. So the difference is a taxable temporary difference. That's the interest receivable. Then the next item is fines payable. Fines payable. The tax base is going to be 0, but this fines is a disallowable expense, so it's a permanent difference. So we'll put dash there. And finally is the interest payable. So which is 10,250, 10,850. And since they said this is also going to be deductible on a cash basis, so then I will have 10,850 as a deductible temporary difference, because it will be deductible on a cash basis. So deductible temporary difference. And that is basically everything that we have actually mentioned.
Please, I have a question.
Okay, please ask.
Please, I don't understand why the trade receivables is not taxable. Because I was thinking since it will be income in the future to the company. Like,
Okay. So this trade receivable adjustment was in respect of the allowance for doubtful debts. Allowance for doubtful debts. So allowance for doubtful debts is they told us from this question that it is only allowed for tax purposes when the debtor is in the process of winding up. So that means it is not allowed for tax purposes. It is not allowed. So the taxman will not allow it. So the taxman that's why we added it back to the trade receivables to get our tax base. That's why we added it back to get our tax base. And you see that it's coming in as a deductible. It will be allowed in the future as a deductible temporary difference for that trade receivables. Okay, Ufoma?
Now this fine payable, I am suggesting that is an allowable expense because it's a fine that they need to pay. Though the tax is disallowing it, but they must still pay it in future because that's what I feel.
Okay, so based on Nigerian law, fines and penalties are disallowable. Whether you pay it now, whether you pay it whenever you pay it is disallowable at every point in time. So for that reason, it has no tax consequence, future tax is disallowable. So when you have items like that that are disallowable, so it's a permanent difference. So which is why we put dash under temporary difference. So zero, the taxman will not capture it because it is allowable. We didn't put it as a temporary difference because it's permanent. It's never disallowed. It's never ever disallowed. Okay, I need more questions, please. So far, I'm still looking at this. I don't like the way these examiners, the way they just say their questions at times. It's just very annoying. Because why would they even put capital allowance on a statement of financial position in the first place? It has no business there. It's okay for them to have given us the costs. They will just complicate and set questions that are incorrect. So what's this guy doing here? So because if I were in your shoes also, you want to look at it very technically like you have done. This one, this 205,000 is the carrying amount, which means that they have already deducted this. I will just add it back so that I can get my costs of the assets because tax base is actually cost minus capital allowance, not carrying amount minus capital allowance. So I think I should just better that way because this question itself is not correct. It's for them to actually put it this way. What is capital allowance doing on the face of the account? It has no business there. So sure it was a mistake from their end. So I think Mufoma, I agree with you. Let's do it the way you suggested. I think that's it's more technically correct if you want to look at it from what we have done in this class. So that means this office equipment here. So the tax base of that office equipment, I want to so tax base of the office equipment. Yes, go ahead, please. I can see your hand.
Sir, but when you check the solution, that's what they did. That what you did now, that's what they did. And also for that fine payable, they deducted it as a taxable element. So I was somehow confused. So that's what
And that's
I'm saying.
why you have been very technical before. You now spoil it with dubbing solution. Their solution is not always 100% correct. Always stick to, which is why I'm trying my best to solve all of these questions for you. Because I don't really care about their solution. The solution is not ICANN represented. They put a disclaimer there that is not from ICANN, is from, so it's a third party solution. So whatever it is they have done, always focus on the principle we have taught you in class, which is what you have done before you went to adopt the solution. Now you're now biased
I
and
did not drop the solution because I was really that's what I did first because I tried it and that's what I did. So when I checked, I saw that it's wrong. But that's why I say, okay, let me bring it up in the class because on a normal base, that's how it's supposed to be.
so let's continue, please. So 205,000 plus what was the depreciation? 28,250. 28,250 minus the capital allowance, which is 22,500. So how much would this give us? Point your calculator, please.
$210,750.
Thank you. 210,750. So what's the difference?
$5,750.
5,750. Okay, so this gives us a deductible temporary difference.
Yes.
So can you cumulate all this together for us? What do we have? So don't forget that this is minus, so that you can just add these four together first. Then you see whether it's higher or lower than this 68,300.
We have 36,600 for the deductible.
Okay, deductible
It's 31,700.
is 31,700. Okay, so since it's don't give me separately, just cumulate everything.
Yes, that's the correct one.
That's the correct for everything, sir.
Okay, so that means it will be taxable then. And that will be a taxable temporary difference since this is taxable. So the deferred tax liability is 30% times 31,700. How much is that?
9,510 naira.
9,510. Okay, so that's the solution to the second one, being that's the deferred tax balance. So we're now asked for the movements. So they give us the opening deferred tax. Okay. So that's the movement in deferred tax. I'll compare my opening deferred tax. How much is that? 8,100. What's the closing deferred tax? 9,510. Then we'll have an increase in deferred tax. Deferred tax liability. What's the difference?
1,410 naira.
Okay. So that's the solution to that. That goes to your PL. This movement as an expense. Okay, so this is a very good question for you to learn about deferred taxes. And there's this other one also, very similar to that. So I won't bother solving this one. This one is a little easier than that previous one. So for those of you, you can try this one. Is simpler than this previous one. So let's solve this diploma IFR question. Let me just scroll it so that we can. Okay, so let's have somebody read for us, please.
Okay, I'll read.
Okay.
A deferred tax liability is the amount of income tax payable in respect of taxable temporary differences. A deferred tax asset is the amount of income tax recoverable in future periods in respect of deductible taxable differences. A taxable difference is the difference between the carrying amount of an asset or liability in the statement of financial position and its tax base. Required: 1. Define the tax base of an asset as outlined in IAS 12. Income taxes. Use your definition to compute the tax base of the following assets. A machine was purchased during the current accounting period for 250,000 naira. Depreciation of 50,000 naira was charged in arriving at the accounting profit for the current period. A deduction of 100,000 naira was given against taxable profit by the local tax authorities against the taxable profit of the current period. The remaining costs will be deductible in future periods, either as depreciation or as a deduction on disposal. 2. A current asset of 60,000 naira relates to interest receivable. The related interest revenue will be taxed on a cash basis when it is received. 2. Define the tax base of a liability as outlined in IAS 12. Use your definition to compute the tax base of the following liabilities. 1. 120,000 naira is included in trade payables. This amount relates to purchases which qualify for a tax deduction when the purchase was made. 2. 40,000 naira is included in accrued liabilities. A tax deduction relating to this liability will be given when the liability is settled.
Okay. Let's solve this one before we go to the next part of this question. So the first solution here, this question says define tax base of an asset. So the tax base of an asset is the amount that will be deductible or taxable in future period in respect of the assets. In respect of the assets. Yes, let me keep it that simple. So they now said we should compute the tax base. They give us two questions. So the second part of the question is asking us to do computation of tax base of an asset. The first part, to get tax base, you just the machine. You're talking about a machine that was purchased for 250,000. So that gives us the cost of the machine, which is 250,000. They give us the depreciation of 50,000 was charged to arrive at the accounting profit. And I say a deduction of 100,000 was given against taxable profit by the tax authority. Okay. So that means that will represent my capital allowance, which is how much? 100,000. That means my tax base is 150,000. Let's call that let's say that's one. The second one, it says a current tax asset of 60,000 relates to interest receivable. The related interest expense and interest revenue will be taxed on a cash basis. So can you tell me what's the tax base here?
0.
Thank you. Since the tax base, since the related interest revenue will be taxed on a cash basis. The tax base is 0. Because that means they won't tax it. Then the second part of the question says you should deduct the tax base of a liability. I will deduct it, I will define it the same way. So the tax base of a liability is the amount deductible or taxable in the future period in respect of the liability. So we're now asked to do computation of tax base of a liability. So two scenarios as well. So we're given 120,000 is included in trade payables. These amounts relates to purchases which qualified for tax deductions when the purchase was made. So can you guess what the tax base will be here?
It's still 0, sir.
Okay, so since the related purchases, purposes qualifies for tax deduction qualifies for tax deduction, meaning the taxman will capture it, which shows that the tax authority will allow it for deduction. Tax authority will allow the amount for deduction. Then the tax base is, how much are they allowing? 120,000. So the tax base is 120. Since they are going to, it qualifies for tax deduction, so it will be allowable as a deduction. So tax base is 120. Then the second one says 40,000 is included in accrued liabilities. A tax deduction relating to this amount will be given when the liability is settled. So similar to it to be allowed as a deduction when on a cash basis. Okay, so that means the cash base now, the tax base is 0. Since the tax deduction will be given when the liability is settled, this shows that the tax authority will not capture this amount. Hence, the tax base is 0. Okay. Do you have a question?
So I was thinking that tax base for payable, because when payable is made, when purchase is made, it will be deducted.
Which one? See this one?
Yes.
Okay. So what are you thinking?
I'm thinking that the tax base is supposed to be 0 because it said it's qualified for a tax deduction when the purchase was made. Is he not talking about cash?
Okay. So why are you assuming that the purchase was not made this year? Hello, farmer. So that means the purchase was made this year. So if let's say the purchases was made, let's say in the previous year, so that means it has already been deducted in the previous year, something like that. So, but here they said it's qualified for that deduction when the purchase was made. So we'll just assume that it was made this year and the taxman has captured it in his own books as well for the year. Okay, can you hear me again? So let's go to the second part of the question, which is the B part. So this one says that Epsilon prepares financial statement to 31st March each year. The rate of income tax applicable to Epsilon is 20%. Okay, this one gives us the tax rate. The following information relates to transactions, assets, and liabilities of Epsilon during the year ended 31st March 2016. Number 1, Epsilon has an investment property which it carries under fair value model. The property originally cost 30 million. The property had an estimated fair value of 35 million. on 31st March 2015, and 38 million on 31st March 2016. In the tax jurisdiction in which Epsilon operates, gains on fair value of investment properties are not subject to income tax until the properties are disposed of. Until the properties are disposed of. Okay. This one scenario. Another scenario says that Epsilon has a 40% shareholding in Lambda. Epsilon purchased this shareholding for 45 million. The shareholding gives Epsilon significant influence over Lambda, but not control. And therefore, Epsilon accounts for its interest in Lambda using equity method. The equity method carrying value of Epsilon investment in Lambda was 70 million on 31st March 2015 and 75 million on 31st March 2016. In the tax jurisdiction in which Epsilon operates, profits recognized under the equity method are taxed if and only when they are distributed as dividend or the relevant investment is disposed. Okay, this is another scenario. And the third one says Epsilon measures its head office property using a valuation model. The property is revalued every year on 31st March. On 31st March 2015, the carrying value of the property was 40 million and the tax base is 22 million. During the year ended 31st March 2016, Epsilon charged depreciation in its statement of profit or loss of 2 million and claimed a tax deduction for tax depreciation of 1.25 million. On 31st March 2016, the property was revalued to 45 million. In a tax jurisdiction in which Epsilon operates, evaluation of property, plant, and equipment does not affect taxable income at the time of evaluation required. Assuming there are no other temporary difference other than those indicated above, compute the deferred tax liability as at 31st March 2016 and the charge or credit to both P&L and OCI relating to deferred tax for the year ended 31st March 2016. You should include brief explanation and to support your computation. All these for 12 marks. Okay. Good question. Good question. So what are we looking at here? So they want us to calculate liability in 2016 and also what goes to P&L and OCI in 2016. So, and I can see that each of these are different transactions. So let's treat them in their own rights. So the first one is actually talking about an investment property. So, and deferred tax is so easy that it's systematic. I know that deferred taxes are determined based on temporary difference, and temporary difference is just comparing carrying amount with tax base. So in this case now, since they want me to determine the deferred tax balance first in 2016, and I can see them giving me figures for 2015. That means I would need to sort 2015 before proceeding to 2016 because it's that movement between the two that would account for the deferred tax that goes to P&L between the two balances. And from here, I can see that this investment property is carried under fair value model. And the cost of this property was 30 million. And the value rose to 35 million in 2015 and 38 million in 2016. Okay. And I was told that in the tax jurisdiction in which this company operates, any gain in fair value are not subject to tax until the properties are sold off. Okay, so they won't subject it to tax until the property are sold off. Okay, good. Reasonable. So at 31st March 2015 first, I will get my carrying amounts. In this case, for investment property at fair value model, you need to understand clearly that they are not depreciated. They are not depreciated. Therefore, the carrying amount in 2015 remains the costs because depreciation wouldn't have been charged. So we're looking at 30 million. The tax base, no, sorry. So in 2015, the carrying amount is now the fair value because they had fair valued it in 2015. So the carrying amount will clearly be 35 million. However, since the taxman does not subject fair value gains to income tax, so he would clearly ignore that fair valuation and still relies on the cost of the assets. So the tax base would remain the costs of that assets. So for that reason, they arise a, a temporary difference that is taxable because the deduction here is lower in the future. You're talking about 30 against 35. So we are having a taxable temporary difference of 5 million. And if I apply, I think the tax rate in this jurisdiction, the examiner told me is 20%. Then I will be looking at a deferred tax liability of 1,000. Let me confirm that 20%. Okay, the rate of income tax is 20%, correct? So my deferred tax as at 2015 is 1,000. Now, in 2016, at 31st March 2016, my carrying amount will have changed because the question told me that in 2016, the fair value is now 38 million in 2016. So we're looking at 38 million. The tax base would remain the same since the tax authority does not allow fair value gain. It's still going to remain a cost of 30 millions. So again, we are having a taxable temporary difference of 8,000. If I apply 30% on that, it gives me a deferred tax liability of 20% times 8 million. Then I'm looking at 1,600. So for this, the deferred tax charge to POL in this case is going to be the opening deferred tax, which is 1,000 compared with the closing deferred tax liability, which is 1,600. The difference is 600. And that is an increase in deferred tax liability. And that will be recognized to POL and it's 600. So, see, you need to be very careful here. The only reason why this is going to POL is because this fair value gain arising from investment property that are measured at fair value model, the fair value gain goes to POL. If it had been a revaluation surplus that goes to OCI, the related deferred tax would have also gone to OCI. Okay, so in this case now, this is free to go to P&L. So that's the first transaction. The second transaction is talking about Epsilon 40% shareholding in Lambda. Because Epsilon purchased its shareholding for 45 million, and the shareholding gives Epsilon significant influence over Lambda, but not control. Therefore, he has to apply equity method. I haven't taught you IAS 28, but some of you might have done it before. I'll teach you that later when we start group accounts. We're told that the equity method carrying value of Epsilon's investment in Lambda was 70 million, okay, which is in 2015, and 75 million in 2016. In the tax jurisdiction in which Epsilon operates, profits recognized under equity method are taxed if and only if when they are distributed as dividend or the relevant investment is disposed. You see, when you are using equity method for investments in associates, like in this case now, you see that this guy bought that investment for 45 million. But at the end of 2015, that investment of 45 million has now increased to 70 million. You see, that increase is as a result of share of profits. It's as a result of share of profit. You see that it also increased further to 75 million. It's also because of additional profits he has made from that investment. That's why it's going up. And in this jurisdiction, such profits are not taxable. They are only taxable when that profit is distributed as dividend. And in this case, they haven't been distributed, but they will eventually be distributed. And they didn't tell us that they will not be distributed. If the question had told us that they will not be distributed, that means it's a permanent difference. That means a permanent difference. But in this case now, since the question is silent, they didn't tell us whether it will not. That means they will definitely distribute it as dividend eventually. So it will then be taxed at that point in time. So there's a temporary difference because it's still going to be taxable in the future. So let's pick that one by one. Investments in associates. First, at March 2015, you need to get what my carrying amount is. In 2015, the carrying amount went up to 70 million. It went up to 70 million. And the tax base will remain the costs because since it's not taxable, of 45 million. It remains the cost of 45 million. So I have a taxable temporary difference. Since my deduction is lower of 35 million. So which will result in a deferred tax liability position of, in this jurisdiction is 20%. 20% of 35. That will be what I can see here. That will be 7,000 because 10% is 3,500, then 20% is 7,000. So at March 2016, the carrying amount from the correction is now 75 million. Has gone up to 75 million. The tax base from here, the tax base will remain the costs to not change because it's not taxable. Taxman will not allow it. So still, I'm having a taxable temporary difference of, what's the difference now? Of 30 million. So, which will result in a deferred tax liability of 20% of 30 million. And that will give us 6,000. So the deferred tax charge to profit or loss will be the opening deferred tax liability, which is 7,000. Compare that with the closing deferred tax liability, which is now 6,000. In this case, we have a decrease in deferred tax. That will be a deduction. To be a deduction from your P&L. A decrease in deferred tax goes to P&L. It's a deduction. Then the third scenario, which is talking about Epsilon measures its head office property using revaluation model. The property is revalued on every year on 31st March. So in 2015, the carrying value of the property is 40 million. The tax base is 22 million. During 2016, Epsilon charged depreciation to POL and it claimed a tax deduction for tax depreciation of 1.25. So in March 2016, the property was revalued to 45 million. In the tax jurisdiction in which Epsilon operates, revaluation of PPE does not affect taxable income at the time of evaluation. Okay, so we are talking about office property here. Office property. So in March 2015, what was the carrying amount of this office property and what was the tax base? First, in 2015, we were given it on a platter. We were given the carrying amount to be 40 million and we're given the tax base to be 22 million. So 40 against 22. So the difference is also a taxable temporary difference. Taxable temporary difference, which is 18. Then we'll have a deferred tax liability, which is 20% of 18. Since 10% is 1/8, 30%, 20% will be 3/6. Then in March 2016, we would also determine the carrying amount as well as the tax base. And given some twists that the question brought, it said in 2016, they charged 2 million. They claimed capital allowance of 1.5. They now came and said that it was evaluated to 45. So that means this is the carrying amount, 45, because that's the fair value, that's the valued amount. That's what will be in the books, 45. But for the tax base, is the previous tax base of 22 minus the capital allowance they charge for that period, which is 1.25. This was the previous tax base. This is the capital allowance for the current year. So 22 minus 1.25, that is like 1,250. So how much is that? That would be 2,750 as my tax base. So this also will result in a taxable temporary difference. So can you get me the difference? Ordinarily, it should have been 25, but with this 750, you should be looking at 24,250. Yeah. So this would have a deferred tax liability of 20% times 24,250. Can you punch calculator, please? That's 2,425 times 2.
4850.
4,850. Okay, now there's a technicality here, right? I'll show you now, which is the deferred tax charge to profit or loss and OCI. Why I'm saying an OCI, because since this asset is valued at evaluation model, that means, and they revalue the asset to 45. That means there was a evaluation surplus that will have gone to OCI. So the related deferred tax related to that amount would go to OCI as well. So I need to get how much of the deferred tax goes to OCI. So first, so to determine the deferred tax expense be recognized to OCI, to OCI, we need to determine, need to ascertain the portion relating to the portion of the deferred tax relating to evaluation surplus. And it's very straightforward. So first is, so that means determine the revaluation surplus. Then you get the deferred tax on that. Determine the revaluation surplus, which is the fair value of 45 million minus the carrying amount. And the carrying amount, what was the previous carrying amount? It was 40 million. What was the depreciation for the year? 2 million. So that's supposed to be 38 million. So it was 40 minus 2 million. So it should be 38 million. So the evaluation surplus is actually 7 million. So the deferred tax related to that surplus is simply 20% times that 7,000, which is 1,400. So now, let's then get the deferred tax charge now. So let me say workings for this now. So I can then do my opening deferred tax. Opening deferred tax ability, which is 3,600. The closing deferred tax liability, which is 4,850. Can you get me the difference? There's an increase in deferred tax. What was the increase? That's 400. That's
1250. 12
1,000.
1250.
1,250. Let me see. Okay, we're on the right track. So this increase in deferred tax that we have, what portion will go to P&L and what portion will go to OCI, because everything cannot go to PLL. So deferred tax to OCI, that's 1,400 from what we computed here. So if I take this one away from it, deferred tax to PLL, what's the difference? That's a negative 150 is what will go to PLL eventually. And that's the end of this question. So from the requirement of this question, we're asked to do the deferred tax balance in 2016 alone, and also the charge to P&L and OCI in 2016. But you see that for each of those items, I didn't just jump to 2016 because it will not fly. I had to sort 2015, then I did 2016, then I looked at the increase that goes to P&L. The same thing I did to these investments in associates, the same thing I did to this office property. But for this office property now, since there was a revaluation surplus and the related deferred tax on that would have to go to OCI. So I carefully calculated the revaluation surplus. I applied 20% on that, which is giving me 1,400. So this 1,250, 1,400 would go to OCI, and a negative 1,150 would be recognized to PLL. Since they didn't ask me to prepare any statement, so I won't really have to go ahead preparing all of these statements. Okay, so that's it for this question. This is a diploma IFRS question, so I'll share you the solution. Also,
Hello, sir.
yes, Uma.
So what about if you combine all of them, as in for 2015 you do all the assets together, then you consolidate it, then go to 2016 and get the increase in deferred liability. Is it same? Will it give you the same answer?
It should. If that is easier for you to do 1 year for each of them, you do another year for each of them. If it's easier for you, it might get complicated like that way. But if you can try it, it should give you the same. But it's better you do it transaction by transaction like that. in this type of question, so everything will not scatter. So also in November 2024, hmm, can you see my new screen, please?
Yes, sir.
Okay. So in November 2024, ICANN asked this question, and they said that if you look at the requirements, they said briefly explain and show necessary calculations, if any, of any deferred tax implication of each of the transactions 1 to 3 above, and show the deferred tax effects on the draft statement of financial position. So I'll be solving, if I don't do that, remind me to do that, we should solve a lot of diploma IFR questions together, because I can't, most of all your questions are from there, to be frank with you. All your questions are actually from there. So most questions I also solve for you that I use as examples, I also pick it from diploma IFR, because I know like most questions I solved for you on this, I use as scenarios on income tax are from there, because that's where they pick. So this question is a little similar to the one we've just solved, just that this one, let's look at it together and see. I won't solve this one. I just want to read it so that you can go and try it for yourself as assignment. And again, I would strongly advise you that always, all of this question, try it, send the solution to me so I can give you the solution. If you just jump to their solution and start reading it, you're not really adding value, and the solution might even be wrong. So this question says, below is the statement of financial position of Bamboo PLC, which has a number of subsidiaries in all geopolitical zones of the country, and also one foreign subsidiary located in the US. So I was given the statement of financial position of this company. Okay. We're now told that Mr. Agbaje, the finance director of Bamboo, is in the process of preparing final draft of the financial statement, and the following issues relating to the treatment of deferred tax implication arose. So number one is PPE. Says that on 1st November 2022, Bamboo purchased an item of PPE for 120 million, which qualify for a government capital grant of 20 million. The asset has a useful life of 5 years and is depreciated on a straight line basis. Capital allowances are restricted by the amount of grants. The company income tax laws specifies a capital allowance rate of 25%. Okay, so of course, you know that you need to get what's the carrying amount, what's the tax base, and this one seems quite straightforward. The only thing is that I can see that they are introducing a government grant here. And as an expo, IS 20, hopefully I'll teach you as a revision one of these days before the end of August. I mean, between this week or next week, I should revise some minor standards with you, or maybe early September, who knows. But IS 20, when you have government grants, it has two ways of treating it in the books, right? So you'd leave it as it is as part of the costs of the assets, then the other leg goes to other income in your POL, or you treat it as a deduction from the carrying amount of the assets. Either one is okay. Either way you treat it is okay. So since this company, they bought an asset for 120, and out of this 120, government gave them a grant of 20 million. So you can leave the cost of your asset at 120, and you can decide to make the cost of your assets 100. So that means you're treating it as other income, the other leg, or you're treating it as a deduction from asset. Okay, for me, either way is either you'd leave it to be included in this your 120, and you can decide to remove it. So the impact of that is when you're calculating your carrying amounts. Okay, what do you want to use as your costs? You can either use 120 or you can use 100, depending on whether you have decided to remove this 20 million. Me, I will have used 120 direct, right? So my depreciation will just be 120 divided by 5 years. Whatever I get, I remove 120 from it to get, I do 120 minus that depreciation to get my carrying amount. My tax base, since the examiner told me that capital allowances are restricted by the amount of grant by FRS. Okay, so I mean, of course, I've seen this question before, and again, I just intentionally paused because that was exactly how I paused when I saw the correction initially. Because what exactly are they talking about? What exactly are they talking about? Is there any one of you that can tell me what these guys mean here? Because it doesn't make sense to me. They
Hello?
said capital allowance are restricted by the amount of grants by FRS. What does that mean?
So I would say anything above that government grants will not be allowed. You know, when you find the 25% of capital allowance, if the amount is higher than the government grant, it will not be allowed. So it must be 20%, 20 million.
Okay, restricted. Yes, that makes sense. I think I agree with you, Ufoma. But is it so? If you look at what these guys now wrote, they say capital allowance are restricted by the amount of grants by FIRS, as if FIRS is like there's a grant that FIRS is giving or something like that. Sort of by the amount of grants by the government or something like that. But let's just interpret it, which is how we'll have also, because that's the only thing that makes sense here. From that means they are going to restrict their capital allowance to the amount of the grants. So by the time we do 25% of 120 million, if whatever we get is above 20 million, so we'll restrict it to the amount of the grants. Yes. But the way these guys have put it here, I mean, they didn't know how to, wherever they dubbed this question from, they didn't dub it accurately. So the company income tax law specify capital allowance. So that's how this will work. So we can easily get carrying amount and tax base. I will really need you guys to get the taxable difference here or deductible temporary difference. Let's see what the this thing would be. The deferred tax would be. The same thing here too. This is similar to what you should know very well. So this guy, Bamboo, acquired a wholly owned subsidiary, Iroko Limited, for 100 million. On that date, the fair value of Iroko Limited net assets was 80 million, carrying amount 70 million. So which is also the tax base under income tax. So the difference in fair value and book value relate to an item of income which Iroko currently has no plan to sell. Okay? I need you guys to try your hands on this. Please don't dub the answer. Just try and see if you get it right. Let us know. This is a very straightforward one, but there's something here that changes everything. There's something here that changes everything. So look at it. And here also, um, so he has a foreign subsidiary that made a profit of $5,000 and it will result in additional tax payable of 4 million if remitted. They now said Aspaco Limited is relatively new and a rapidly expanding company. Bamboo intends to leave the earnings with Paco for investments. Okay. So I need you to try your hands on this too, but the solution is clear, if I might tell you, because they are saying that this profit is only taxable if it's remitted to me. But they are saying they won't remit it to me. That means it's never going to be taxable. So no deferred tax implication. That's the solution to that anyway. Please try your hands on a question like this. It's a very simple one. Let's see what you can make out of it. Okay, so let me stop sharing this. So I think I've tried for you guys on income tax. My plan before I was supposed to move into provisions today. I just said let me solve more questions with you, considering the importance of this. So, and one thing I just need to mention as a final note for you is that note that deferred tax assets is only recognized to the extent that there will be future taxable profits against which the deductions can be utilized. A company that has a history of loss making can be said not to not have a future taxable profit. Therefore, we cannot recognize deferred tax assets for such a company. Okay, so I just needed you to note this down because deferred tax asset is only recognized to the extent that there will be future taxable profit against which the deductions can be utilized. Because the deferred tax asset arises from deductible temporary difference. So IAS 12 says that you need to be sure that there will be future taxable profits. And the way we usually determine it is that they say a company that has a history of loss making can be said to not have a future taxable profit. So that means a company that is making profit, then we can assume that, okay, this one will have a future taxable profit, then we can still go ahead and recognize the deferred tax asset. But a company that has been making loss, if it makes loss this year, or probably makes loss again last year, then you cannot recognize deferred tax assets for that company. Because where is the future taxable profit anyway? So that needs to be really noted. I'll end it for you guys for tonight, so you can go and rest. We have done good 2 hours. So on Saturday, I'm going to commence. I'll do IS 37, of course. I think that will be the only thing we will do. IS 37 is not so big of a standard, but again, we'll solve a lot of past questions just for you to get used to. So what will take most of our time is not the explanation. The principle of IS 37 is very straightforward. So it's past questions that will take a lot of our time. And again, I'll solve past questions from Diploma IFR. So hopefully you will see similar questions in your exams when you do that. And also, I have IS 10 in perspective, IS 10 events after the reporting date. So I'm looking at those two. Um, so have it in mind that I'll be having you guys this weekend on Saturday And I'll also be having you on Sunday. I'm going to start our Sunday classes consistently. Now, I'll be very consistent with our Sunday classes because my 7 weeks intensive class on case study is going to be start by September the last weekend of September up to so my Saturday and Sunday will now be very fixed and tight. So I want to utilize that free Sunday period that you guys have. I want to utilize it for us to be solving past questions and for us to be making up any lapses we have. We'll use that time to make up so that we can go as far as we can. So for you guys, we are moving at a very good pace. Keep watching the videos, keep using your working notes, keep practicing questions. Um, um, so hopefully this month we're able to cover that IAS 37, IAS 10, IFRS 15 on revenue. I have IFRS 16 on leases, and I also have IAS 8 on accounting policies. So it is when I've satisfactorily done those ones, then and maybe IFRS 18 also, the new standard on presentation of financial statements, because I need you to be exposed to that. Then we'll go to group accounts, consolidated accounts. So consolidated accounts, um, we'll be having 7 solid classes for that. 7 classes. That's looking at around 17 to 18 hours of active class to cover that. And we're going to do a lot of past questions. And the reason why I'm covering a lot of standards is because the consolidation group account itself is not difficult in terms of the principle behind it. So ICANN now does not really test just principles of group account of consolidation. So they really want you to consolidate by firstly adjusting the individual account of the members of the group. So it requires you to be very grounded on accounting standards, which is why I'm taking a lot of my time to do this. And finally, is that for those of you that have not been doing assignments, that have not been reading, then I think we are now at a time where what I've told you from day one will not start happening. In the sense that it is now, you will now see that the workload is now too much. Those of you that plan to do 4 before, we now say, okay, I cannot do 4 anymore. Maybe I should do 1. Maybe I should do 2. And it's your doing. It's really your doing. You can say you're busy. Everybody is busy. And you would always be busy. It's just about allocation of time early enough and commitment to a course. Anything you're committed to, you create time for it. However small the time is, a 15 minutes, a 20 minutes every day with discipline will have gone a lot at this point in time. So don't fall in that trap. Whatever it is you have predetermined your mind to write, if you have set your mind right from the outset that you're going to write 5 papers, don't allow procrastination to make you change your mind to 2 papers. That means you're adding another 6 months of your life to ICANN when you can just get it over with immediately. So don't do that. Let discipline take the helms of affairs here so that you'll be happy with yourself in November. So let's leave it here for tonight. If you don't have any question relating to income taxes, then I think we're going to close the chapter on this topic, and I'll see you on Saturday, where we're going to be tackling IAS 37 on provisions. Thank you very much. See you on Saturday.